Hello and welcome to Trading a Smaller Account. My name is James Boyd, standing in the stead of Barbara Armstrong, and she will be back next week. She's in Maui. She's probably on the beach somewhere. I don't want to be on the beach. I want to be right here, okay? Don't want sand stuck between my toes. I don't want none of that stuff, and I want to be right here. So, a little fun there. I'm not a beach person. The only water I touch is the pool, okay? So, a little fun there. And for Barbara, we like to welcome Gary, Michael, Ricebird, Bill Bornhoff, Eva, and many others. We also have Scott Thompson in the chat. Many of you remember Scott, and he's with us. Welcome. And just real quick, remember we do post educational content on X. There's my handle down at the bottom. Quick reminder that as we talk about options, remember that options carry a high level of risk and are not suitable for all investors. This class, at least the majority of it focuses probably more on verticals, as I've seen the prior classes be on. And we'll talk about that more and build upon that here today. Remember that the information is provided for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. Remember, there's things like macro analysis, like the general trends of the economy and kind of what some of those numbers are showing, like we saw today with non-farm payroll. That can affect fundamental analysis. That can affect technical analysis. So just remember, technical analysis is just a small snippet of what's really happening out there. So be aware of the other types of analysis. Also remember that investing involves risk. And as we do examples here today, remember the class concept that Barbara set before us is want to manage a $25,000 paper money account. Second, max position size 5,000. So if we did buy, let's say, shares of stock, it couldn't be more than $5,000. And last but not least, max trade risk 500. Now, I saw in the comment that some of you might ask, well, wonder if I didn't want to maybe take a max loss of 500. Wonder if I only wanted a fraction of that. We'll talk about that here today in an example as well. Now, when we talk about time frame, we're talking about short to intermediate. So if someone said, what does that mean to me? I'd say 2 to 3 days to 2 to 3 weeks, probably in that time frame. Probably max 2 to 3 months. Okay. Now, notice that it says also right here, trade bullish stocks. Okay. But also the ones that have where we can do bullish option trades on those bullish stocks, but also bearish options. Want to remind us that when you look at the current marketplace, it's not all bullish. Okay. One of the dangers could be when you have a more volatile market is all of your positions are bullish or all of your positions are bearish. It might make more sense to try to play selectively or consider some bullish trades and some bearish trades. Okay. You'll tend to notice you might feel a little bit more exposed when the market goes down and all your trades or near all your trades are bullish. Okay. We'll talk about that here today. So let's go ahead and just hop right in for just a moment. Quickly. Dow Jones, low of the session. Smash through the descending triangle. We talked about this morning on the ETF class. Okay. There it is. Big, long red candle. Okay. Now we haven't closed there, but nevertheless, we did drop down below the floor. Yep. Knocked the hole right through the desk here. Just kind of looking to see if it fell down to the next support. 412 is being the target that we actually had from earlier this week. Dow Jones also, large cap stocks, kind of facing the headwind of the US dollar. S&P, just quick look, down at the low as well. Okay, so we did an example trade on that. This morning, on a product that's similar to this, or trying to track that, you look at the NASDAQ, just briefly, that is also a fresh new low. And you look at the Russell, your favorite, that did also blister down to a fresh new low. Now, when you kind of talk about like examples, if we see the indexes are like that and volatility is up, wouldn't stretch the imagination that there's probably some bearish examples in the marketplace right now. Now, today's lesson I like to really call bearish trends game plan. Now, sometimes we're kind of like shy about bearish trends, okay? Because we haven't practiced them as much as bullish. That's okay, okay? what we want to do, and I kind of think about this in tennis, okay? I think about my forehand as like that's my bullish trends. And I like to hammer that forehand. Absolutely. Okay. Speaking of the Australian Open. Now, bearish is kind of more the backhand. It feels a little unusual. You don't do it as much, but it could still be a very potent hit. And if your name is Bill Barnhoff and you know who you are. So the biggest actually thing is we want to kind of be good or at least educate on both. So if we get some different types of trends, we don't feel like, oh, I'm not really that good at it. Well, how do you get good at anything? You practice it. Okay. Now, I just want to show briefly, just quick reflect on crude oil. Still up there, faded a little bit off the high after that big move here today. We see that when you look at gold, gold's actually held up a little bit better than oil has. And also when you take a look at, let's say and I'm going to bring up the healthcare sector. We talked about that like yesterday or the day before. You look at the healthcare sector, that's holding up decent. What is not holding up decent is Holy Staples. Okay. Now, Eva, do you have a comment on this? Staples coming right through the floor. Okay. I mean, you would also think that when you look at a lot of these stocks in the area, like Kraft Heinz, Mondelez, Coca-Cola, and Pepsi, that people are not using those products anymore because those stocks have actually come down quite a bit. Now, when we also look at some areas that are also getting hit here today, real estate taking the prior low out, well, coming through the floor of support. And also when you look at communications, which had been an area that had been of interest, that also coming through the floor. Now, we are not going to say that all the examples we look at here are bears. So that's not true, okay? I'd probably say 2/3 bears, 1/3 bullish, okay? Now, what I want to do is I want to kind of compare and contrast some different strategies. So I said kind of the focal point of this class is really bearish trend game plan. Now, Scott and I don't want to say we're older than dirt, but the biggest thing is we've seen bear markets, okay? I'm talking about actual bear markets, okay? Not bearish trends, bear markets. And so these are probably some must-know strategies where you say, look, I feel very comfortable with these, okay? So briefly, I want to talk about the difference between short calls, verticals, long put verticals, but really build up to a short synthetic. Now, when we talk about a short call vertical, we're just selling a call where we think the price could stay below and then buying a call above that to create a max loss. All right, not that bad. Probably done that before. You can also kind of think of like a short call vertical, like a covered call, which Barbara's talked about. But instead of owning the shares, you sell the call thinking the price is going to stay below that short strike. And then you buy a call above that. But you don't own the shares. So that's bearish. You sell a call, you think the price is going to be neutral to drop down. This right here, if you look at theta, this is theta positive. Okay, so many people like that. Theta positive. Okay, so that's kind of one big thing about that one. When we actually look at, let's say, a long put vertical, that's kind of more like theta slightly negative. Not massively negative, but just a little bit negative. And I'm going to say that when we look at a short synthetic, which I'll explain, theta negative. Now, if we take a look at this, you're going to see that when we look at a short call vertical, which we will right now, you're going to see that it has what's called negative delta. Now, if I said negative delta, what does that mean? What does it mean? It's a bearish trend. I should say a bearish trade. Now, when you do, let's say, a bearish trade or it's negative delta, you are wanting the price to decline. On a one contract basis, you'd probably see the delta of that being about 10, and maybe on this one, you might be between about -50 to probably, let's say, -60, somewhere in there. So when I bring up a short call vertical, it's going to have negative delta. You have negative delta, you want the price of the stock to decline so you could benefit from that decline. Second, if you look at a long put vertical, same thing. It probably has a delta of 10. And when you look at a short synthetic, let me rewrite that, -50, well, -50 to probably 60. Now stop right there for just a moment, okay? Why would someone want a higher negative delta position? Now, I remember when a bunch of stocks fell. This is back in 2000, 2001, 2002, 07, 08, early 09. I remember when stocks plunged to the downside, you had the right stock, you had the right strategy, and you said, that's all I made, $200 when that stock fell a lot more than that. Well, the reason why people do a short synthetic is they want a position that has a higher negative delta, a greater sensitivity to the price decline, that if you get that direction right, you could benefit. Now, speaking of that, what is a short synthetic? Well, what you're going to notice is a short synthetic is like what the short call is. It's a short call vertical, okay? So we're taking what we know here, and I know Barbara's taught you this, okay? And so we're taking that short call vertical, and we're going to bring it over here. That short call vertical gives us a credit, okay? Now, what could we do with the credit? Well, what we could do with the credit is we could use that credit to go pay for the long put, which is a debit. So if I were to ask you, why don't you buy puts? The number one answer is probably like, A, I don't do options. Second answer behind that for sure is, well, I just don't want to pay for it. Okay, that's what people say. I've asked people for 25 years, why don't you buy puts? Those are the top two answers, okay? So if we could use the short call vertical for credit and then use that to buy the put on top, that's going to create that bigger negative delta position. So if you said, is a short call vertical bearish? Yes, it is. Is a long put bearish? Yes, it is. Short put is bullish. Long put bearish. Now, let's kind of talk about some examples here for just a moment. Now, one of the stocks that's kind of getting a little, well, I'm going to go back to just real quick the discretionary sector, okay? So we saw this morning that we had the non-farm payroll. They were 100,000 higher than what they had anticipated, okay? Now the Fed, they had thought that they were going to cut maybe twice this year in terms of the Fed funds rate, the interest rates. Well, with some of the data that we saw this week, okay, from the JOLTS numbers and the non-farm payroll, people are thinking, is the Fed going to be able to cut rates at all, okay? Now, you might be thinking, well, what do rates have to do with the stock? Well, these companies also borrow money. But wait, if they borrow money, but it's at a higher rate, that affects sales. It also affects earnings per share. Now, wait, if you affect earnings per share, that might affect valuation, that some of the valuations are too high, that technically these trends might be a little high and they might start to sell off, okay? Now, in our example, I'm going to start with Amazon example given, okay? Now, what we're looking for, if we're talking about bearish trades, we're looking for the prices below the moving averages. The moving averages can act like a level of resistance. Come to my class, I call it resistance. Okay? But really what we want to kind of see is the price up against resistance and falling back down or bouncing down or breaking below a support level. Now, normally when we talk about bullish trades, we say, where do you see the resistance? Where do you see the resistance above that? Well, this kind of being the opposite here, okay? If we said, hey, look, I see the support level here, and now it's reversed. Instead of saying resistance, where do you see the next potential support? Well, you kind of had an old high here, which is probably about 213. You might have had like another plateau at 205, and you kind of had another level here about 197. Now, let me kind of speak to this for just a moment, okay? If we all said, hey, look, I normally am a buyer of stocks, and I then ask the person, well, when do you not buy stocks? The person says, well, I don't buy stocks when we're below the 20-period moving averages, okay? And right now I'm striking in buying shares until the price starts getting back above the 20-period moving average. So the investor might be saying, look, I just have more capital right now. I don't see as many stock positions, and I might be doing more options that have defined risk. Okay. Now, when we do a short call vertical, we're selling, just like if you think about like a covered call, right? You're selling a call typically 20 to 50 days out to expiration, and you're picking a strike that has a delta, typically, but not always, maybe with a delta between 30 to 40. That means the strike is above the current stock price. You're thinking that the stock might not be able to get there. Now, what I want to do is kind of compare and contrast short call vertical, long put vertical, and then put it all together, okay? Now, what I'm going to do is I'm going to right click on this 230. We're going to go sell. And actually, let me bring this up right in that paper money account. Pull this up. Let's go Amazon. We're going to go right back so that we can put this in the paper money portfolio, okay? We're going to look at that one. That one was the 230. Right click on the bid of the 230, sell, and I'm going to go right to where it says vertical, okay? Now, if you take a look at this, that is your classic short call vertical with a built-in maximum gain. Now, there's kind of pros and cons to this, right? The short call vertical, in my mind, Scott, speak up. Let us know kind of your thoughts here too. I look at like short call verticals as they're probability based. Okay. It's not the highest profitability. Okay. You can't have both sides. You can't have the highest probability and then the highest potential profit. Doesn't usually go like that. Okay. If we want a higher potential profitability, you normally see or will see probability drop. So I kind of think of, let's say, higher, okay, profitability. And when you do that, of course, it means that you lower prob of being right. Okay? We don't have to be right 100% of the time. We just want to, in this case, kind of want to pick. Do you want to do a probability trade that's more income, or do you want to kind of do something that's more of a debit? And if you're right, you could potentially make more compared to a short call vertical. Now, the short call vertical, it doesn't need to move. The long put vertical needs to move somewhat, tends to be, to get to break even at expiration. So there's a difference. Now, what I'm going to do is I'm going to kind of speak to this, okay? When I right click on this and say analyze the trade, pull it up, I'm going to make sure I delete anything here that we don't want, which we don't. And I said that normally when you look at, let's say, a trade like this, the delta on a one contract basis would be about 10. Here it's about 6, okay? So not very bearish, okay? So that scale would go from plus 100 if we had 100 shares of stock, okay? Or negative 100 if we were short 100 shares of stock. So kind of that scale. 0 kind of meaning we're delta neutral. We're just slightly to the left. Negative 6 delta. Now, what you have to kind of think about is the stock goes up $1, stock goes up $2, stock goes up $3. For every $1 or $2 that goes to the upside is we're losing approximately that amount, or we have an unrealized loss. Okay? Now, what you need to kind of think about is if you said, I'm only going to take a 25% of the max loss, you kind of need to think about that and say, well, if I went to expiration on this, let's go to the February 22nd. Let's kind of say that the stock price is right here, okay? And we're looking to kind of see like the credit is $1.45. So what's the max loss? Well, it's a $5 wide, okay? $5 wide spread, $1.45 credit. That means you have a $3.55 max loss given the vertical. Well, let's kind of say that if the stock goes up to, let's say it goes up to, let's say, 235, okay? So here's the current stock price. Wonder if it goes up to 235. Well, we would have about $132 loss of the 355. What am I saying? Setting a conditional exit based upon 25% of the max loss is not really giving the stock that much of a loss. In other words, it can't go up very much before you're probably going to be at that 25% of the max loss. If we said, okay, we have a max loss of $355, and what's 25% of that? It's $88. So on this graph, we're going to say, look, if the stock goes up, that would mean that the position is losing. $88 is going to put us about right there. So if this stock goes from about 216 to about 228, it's about $11 to the upside, you would be at a $25 loss. By the way, when you look at a percentage movement, that's like a 2% move on the stock. Now, if you asked us how we felt about that, that's an extremely tight stop, extremely tight. And when you said extremely tight stop losses, you tend to get a hit out on a majority of them. And the biggest thing is about that is you're realizing that loss. Would the paper money account do that? No. Okay. The way the paper money account does it is it plays these to expiration within 4 to 10 days expiration. It lets the probabilities play out. Okay. Now, we could talk about why. Now, if we take a look at this, well, that's one reason. Okay. Doesn't give a whole lot for it to move. Now, trade number one here, we're going to do an Amazon short call vertical. Now, what I ask of you is I would like you to paper trade alongside us in the paper money account. Not a real trade. How do you get a sense of how to practice bearish trades? How do you learn them? You practice them. Now, could we also set a target? Could we also say, look, James, if we get down to 209, I want to try to profit take because that's where I think the support is. Or if we get down to 198 or 200, I want to try to profit take. You could do that. You could set up a conditional order to do that. I don't do that because I try to kind of manually show you what's happening and then involve you in the kind of the management of the position. I'm going to go confirm and send. Note the max profit, and let's kind of think back to kind of the rule set in which Barbara set this up, okay? She said the max trade risk was $500. I'm going to go back to this and say, how many contracts could we do? Answer, about one contract. Can't do more than 500. This account's a little higher than what she had, but not too much different. We're going to go ahead and note the commission there, okay? Cost of the trade, including commission, okay, $1.30. Credit, that's taken off the credit. There's the net credit, okay? And now what I'm going to go ahead and do is send that order. Now we can see that position right there. Now, if we take a look at this, I want to kind of show that like a different type of bearish trade. Slight difference. Now, one of the things is if we see those interest rates up higher for longer, people might not necessarily consume as much. Okay? Now, if you look at Airbnb, this is another one that's kind of gone at best sideways. Now, let's say the investor says, James, I see resistance at one of the areas at 139, 140-ish. I see another line of resistance, maybe let's say 136, 137. And if we were to break this support, the path of least resistance might be that it tries to come down to 124, maybe 119. Okay? So first off, we're trying to just be a realist and say the trend has been at best neutral. Okay? You're going to kind of see that when it goes up, it doesn't go up for very long before you see some selling. When it goes up, it doesn't go up for very long before you see some selling. Okay? Usually that's kind of when you're getting a sideways range and you start to put pressure on where the support level is. If buyers get sick of buying only to see the price come back down, they buy only to see the price come down, they buy only to see the price come down, the next couple of times they come down to this area, they might not buy again to support the stock. And then if you don't get buyers to support the stock at the 130 where they did before, what might happen? Well, the path of least resistance is it might fall down to the next support area. Okay? Now, let's go to the trade tab for just a sec. Let's kind of see some slight differences. Now here's the thing. Whenever you kind of teach something above what maybe someone knows or it stretches a little bit, they think that when they do this, that everything that they know before is completely hogwash. That's not true, okay? We still want something that's liquid on the stock. Liquidity on the stock affects the bid-ask spread on the stock. The liquidity on the stock affects, do they have options and are they tight bid-ask spreads? Does that liquidity on the stock also have volume and open interest? Okay? So this is all important stuff that we would be thinking anyways. Now what I'm going to do is I'm going to come over here to we got the calls on the left, puts on the right. Okay? Now I'm going to tell you right now, we're calling this again bearish trades game plan. Back in 2000, I still remember, didn't seem like that long ago, people would say, and I wasn't at the company before, at that time, people would say, next time the market falls down or these stocks fall down, I'm going to be ready. Coming to 2007, people said the same thing. Next time the trends go down, that's when I'm going to be ready. Wait, you said that last time. And the time before that. Okay? And as I said this morning, there's going to be some stocks that probably go down farther than you think. We want to know these three strategies, so if we start to see resistance forming, sideways trends forming, what we saw in many of these stocks is a lot of stocks falling back down to support, where some of those type of price patterns have descending triangles. If you kind of think of like what a descending triangle is, it's like a bear flag that just has yet to really break support in the shorter term, but in the longer term, it's a bear flag, okay? Now, if you get a bear flag and you get an absence of buyers at the support level, you can breach the support level. Now, here's what happens, okay? Yeah, but I'm just looking for upward trending stocks. Well, if you're going to look at the indexes, that's going to tell you what the bulk majority of the stocks are doing. If the bulk majority of the stocks are falling down, do you want to kind of play something where you're going against dominant trends? Now, I'm not saying there might be a couple stocks that go up, but the majority are probably getting pressed down. So we're trying to kind of go with the trend of the market, okay, and at least try to put on a short-term bearish trade. Notice this is not a bearish trade till next year. It's just for the next 42 days. So what we're going to do is we're going to buy a call that's at or in the money. Does anybody know why that is? Why are we going at the in the money? Answer, whenever you kind of like do a long option, you're trying to have some intrinsic value. Really what it's about, okay? Because if you have some intrinsic value, it's affecting the break even, okay? Now, what I'm going to do, and it doesn't have to go down as far. Second, what I'm going to do, I was going to right click on that ask price of the 130, buy, going to go right to where it says vertical. Now, this is a little different because if we were just going to buy a long put, and how many of you ever said to yourself, geez, I wish I would have bought a long put, okay? Well, why didn't you buy the long put? We went over that, right? Yeah, I got to pay for it. Well, notice the debit here is only $2.30. Why is that? Well, it's because it's selling a lower strike, and that's giving us a credit. That credit pushes down what the debit is. Why does that matter? Well, because if we buy the 130 and then we have a debit of $2.30, the break-even survey says we need that stock to go to 127.70. All right? So if we look and see where the stock is now, we're at 129.52. At expiration on the 21st of February, we need the stock to go down about $2. Not quite $2, but about $2. Anything lower than that, it'd be in our favor. How do we make the most, though? Well, we make the most when the stock is below both strikes at expiration. Now, the debit there, $2.25, max gain, $2.75. Now, here's the deal. I'll be honest, I had my mind set with, I was familiar with covered calls. Short call verticals made a lot more sense to me. And I was familiar with long puts. What always threw me off about long put verticals is the selling of the put below. That just seemed different to me. I was familiar with selling the puts, but when I combined those, I was like, God, that's interesting. The purpose of selling the put underneath is to lower the debit. But when you lower the debit, it's going to make the break even higher. So the stock doesn't have to go down as far to break even. Let that sink in. Now what you're going to see in this case is cost of the trade. You got to pay for it. Add the commission. Read that row. There's the total. Now let's kind of compare and contrast just real quick the differences. When we analyze this trade, now notice on the bottom, we get the stock price. Okay? On the left-hand side, or the y-axis, if some of you like, for example, math, you see, the gains, the bigger dollar amounts, is if the stock goes to the left, or in other words, down. What you will see if the stock goes to the right, you're going to see that we have, in this case, there's the losses. There's the max loss. Now, that's kind of nice here because, okay, now you might run into a stock investor and say, hey, stocks are less risky. Well, let's just be honest, okay? Stocks can be risky too. They can fall all the way to zero. Yeah, they don't have an expiration, but they can fall to zero. Bear Stearns, anyone? Washington Mutual, anyone? Keep going? Keep going, okay? They can go to zero, okay? Now, the biggest thing is when we talk about the maximum gain is, remember we said we want the price to be below at expiration both strikes. That's our long put strike, and that's the short strike. So the way this makes the most money is being below both strikes. Now, let's kind of think to ourselves just real quick. Well, do we have to wait all the way to expiration? Maybe you're trying to make a portion of the max gain, right? The biggest thing is if you're going to take a short-term bullish trade or a bearish trade, you are normally thinking, I need to see probably a 6 to 8% decline to make it where the gain potential could be more material. If I said 6 to 8%, how far down is that? That's just 3% down to that level, 3.6. If I go down to this is 6%. When you start getting 6% on a bullish trade or higher on a bullish trade, or if the price falls down 6% or more on a bearish trade, the gains start becoming more material where you start to get a higher percent of the maximum gain and so on. But this 2 to 3% down is not that much. The only way that could make more sense is if you were doing like a short put vertical, a short call vertical, where you don't really need it to move necessarily. But on these more directional type of trades, we need more of a direction to really get more of a gain of that max gain, okay? Now, let's kind of go back to this. Let's send this. Trade number 2, we're buying the 130 put. Now remember, you say you're buying the 130 put, what do you think? Price could go down. Selling the 125 to create a credit, lowering the debit. You lower the debit, affects the break even. Stock doesn't have to go down as much to break even. Quickly, when you take a look at this, we go back to this and say, analyze the trade. What do we got here? What type of theta do we have? Well, notice on this position, the delta is a little bit higher, just a little bit. You're going to notice that the theta is almost neutral. Vega here, though, being positive. Okay? Now, the question comes in from Michelle is 2 contracts on Airbnb. Well, let's go back. We'll double check. Okay? Now, I don't want Barb to be mad at me. I mean, I used to live in Ithaca, New York, and I'd go to Toronto quite a bit as a teenager growing up. The last thing I want is a Canadian being upset with me. That happened one time. It didn't turn out too good. Now, I joke with Barbara a lot. So any of these inside jokes, there's an underlying friendship, and so we kind of joke about that, okay? And Barb's a great gal. Now, what I'm going to do is, if we look at the max trade risk, let's go back to this for just a moment, Could we squeeze two out of there? And the answer is you could. If the investor said, look, I want to kind of go closer to that 500 threshold, it was $225 per contract. If we did two contracts, it'd be $450. Now, we do two contracts, it affects the cost of the trade. Note, and that buying power effect is really just what the max loss is given the vertical. Going to send that order. Now, I want to kind of speak to this just real quick. A lot of times, if these prices were to go down, I want to set like an alert right at the 124. Right click, create an alert. Okay? Now, if I did that, the alert is not an exit. It's just, okay? And I'm going to say, look, if we get at or below, I just want to kind of give myself a little question mark. What does the question mark mean to me? I might want to look and see what percent of that max gain do I have. I'm going to put it right there. It's just an alert. And obviously, if we fall down even lower that, right click on that, of course, and I'm just going to say create the alert, okay? And clearly that's at or not above, that's below, and the same thing. Why? Well, because these are my potential levels of support. Now, what you got to understand what bearish trades is, when they drop, they don't tend to drop forever. So when they tend to drop, why is that, by the way? Well, these fundamentalist people come in, these long-term technicians come in, and they try to buy maybe when other investors might have been pressured to sell. And they try to take advantage of that pressure and try to buy at some lower levels. Maybe we're at longer-term support levels, moving average. We can include fundamentals with this, low Ps, low 4Ps, low valuation, attractive valuation levels, and so on. I mean, so we want to kind of watch those alerts to see if they trigger. If they trigger, look at the percentage maximum gain relative to what we have, okay? You might say, are you willing to take that? Now, I want to kind of piece this all together, and I want to take one more bearish trade here for just a second, okay? Now, I'm going to go back to, let's say, a company called Kitty Cat. Now, Kitty Cat, and I call it Kitty Cat, but it's really Caterpillar. What you're going to notice is we kind of have like a descending triangle right here. Now, we said before that when you take a look at, let's say, a short synthetic. Now, who taught me a short synthetic? The answer is nobody, okay? When I saw markets fall before and we did short call verticals, I was like, okay, fine, we were right some, but it would be nice if you were right more. And that kind of steps into a long put vertical. And then you say to yourself, golly, I like the long put side, but geez, I really picked the right stock. This thing really got pushed to the downside. And how do you make that trade even more bearish? Now let's take the stepping stones of what we did. We're going to do a short call vertical. That's baby step number one, short call vertical, just like what we did before. We're going to sell a call where we think the stock could stay below. Okay? We're going to go to the trade tab. And once we go to the trade tab, we're going to go to that 20 to 50 days to expiration. We're going to sell the call with a delta of 30 to 40, which is going to be the 370 strike, and we're going to right click on that bid, the 690, go sell vertical. Okay? Now, if you pull this up, you got the 370 call and the 380. Now, all I did is I went to the February expiration. I right-clicked, okay, right on the bid. Why did we pick that one? We picked that one because that has that delta 30 to 40, which is out of the money. And that 370 is most likely or is above resistance. Now, there's the credit, okay? Now, what we're going to do is we're going to add a little piece to this. Think of this as we're layering the cake. This is a bearish position. But now if I go and say single order first triggers SEQ, first, now, by the way, if you did not catch our session yesterday, I accept your apology. Okay. Now, the biggest actually thing is, let me actually bring up that, the order types, okay? This is going to be a really good page that you want to, let me just send this to you. Really good on Schwab.com about order types make sure that you have this. Okay. All right. Just want to make sure because that was some good material that we talked about yesterday and continuing this morning and continuing right now. Now, I'm going to come over here to the put side. Now, if you buy a put, you're really picking a put where you think the stock could go down to that level. Okay? So if I go back to the chart, need your help here, where do you think the stock could go to? Well, if we went back to this and say, where do we think the stock could go to? We might say, James, there's a potential risk of maybe the stock falling down to 330. Okay? We might be thinking in this case, the stock might maybe fall down to, let's say, 345 or so. Even if we kind of pick something in the middle here, maybe let's say the 337 or so. Okay? So the put that we buy, we think the stock could stay below that. Or in other words, we could look at this is the put that we buy, we think the stock could come down to that level. Now, the session we did yesterday was the after-hour session at 4 p.m. Eastern. It's already posted. So what I'm going to do is I'm going to click on that 340. I'm just going to click on the ask, okay? Now, we got to make sure we do this right. When we do that, first triggers SEQ, and then click right on the ask of the 340. When you do that, it will not get rid of the short call vertical. And then what it does is it adds that long put on top. Now wait, a short call vertical is a bearish trade. That's true. Right click, analyze the trade, and there is your short call vertical. Okay, noted. If we take a look at this, how can we make the trade more bearish? Answer, buy a put. You right click on this, analyze the trade. And what happens now is it makes this position more bullish. Nope. It makes the position more bearish. Okay? Now let me kind of reset this. And what you're now going to notice is in this case, first thing I want you to watch is look at the maximum gain. This right here is initially the short call vertical. That's a piece we saw before. This right here, where it goes up, 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 if the stock were going to fall, that's because there's a long put. Let me uncheck that. There's your short call vertical with a delta of 919, negative. If we add that long put, it unlocks the upside if that stock were going to go down. Now, I'm going to ask you a question. When you get the direction right, do you like your upsides capped? Let me repeat the question. When you get the direction right, do you want your upside capped? Many of you are saying, oh, that's kind of an odd question. The answer is no, I don't like it capped. And I want to know that there's more of an upside than maybe what a short call vertical has. Well, welcome to a short synthetic. This is what a lot of experienced investors do, where they say, look, I want to trade the probability, but I want to have the potential that if it really goes down, I can have a higher potential gain. Now, notice that the debit, there's a bigger debit, noted. And what you're now going to notice is the delta is negative 44. When we looked at the short call vertical in closing, you looked at a long put vertical, okay, in comparison. This position has a higher negative delta. Where is that coming from? Answer, it's coming from the long put, okay? So if someone says, look, I want to be more right if it were to go down, they want to have a higher negative delta. Now, from experience, okay, when you really get downtrends, having a delta of 50 or 60 tends to feel like a delta of negative 100 because it's more volatile, okay? So that's okay not to have a higher delta than negative 50 or 60 if you were really thinking a bearish trade. So don't think that you have to go higher than that, but this is kind of in that sweet spot because when stocks go down, they tend to be more volatile, okay? So I want you to practice doing a caterpillar short call vertical, step one, and then add that long put. There it is right there in closing, okay? So that right there is what we call a short synthetic, which is just a short call vertical with a long put to create a higher potential max gain. Now, I'm out of my time here today. I will send that through. Want to make sure that we also kind of aware of the schedule. Now, if you say, I don't have this, let me send this to you. Okay. Now, here we are today. And what you're going to notice coming up right at the top of the hour, Advanced Charting Techniques with Cameron May. Also, we have ThinkScript with Michael Fairborn, and I'll wrap it out for the day, literally, on market movers. Boy, has there been some movers. Also, if you said, I don't have the web page for YouTube that I can subscribe to for free, okay? Well, there it is. Just make sure when you click on that page that I sent you, right in the middle of the page, there will be subscribe. And if you do that, you'll be able to see all of our content, ETF content, right on our YouTube page. Why? Because you need to have it right in your hands, okay? Now, I'm out of my time here today. Stay tuned for Cameron May coming up next. I think Barbara will be pleased with what we talked about, and I'll make sure that our good friend knows what we covered as well. So thank you so much for being a lively bunch, and also Scott Townsend for answering those questions in chat. There was a survey, so if you could click on that link, I appreciate that in advance, and I do look at those comments. Now, remember with what we discussed, it was done for example, illustrative purposes only, and this has been the class on trading a smaller account, comparing 3 bearish strategies. With that said, stay tuned for Cameron coming up next. Bye-bye.